Welcome to Finance and Accounting Tutorials. My name is Peter and I will be your host in this particular tutorial. Today, I want us to look at working capital management. Working capital, which is also referred to as the net working capital, is a financial metric which represents the operating liquidity available to a business. Working capital management refers to the administration of both current assets and current liabilities. To get the net working capital, you subtract the current liabilities from the current assets. In the case where the current liabilities exceeds the current assets, then we say that in that particular organization there is a deficiency in working capital, or there is what we call the working capital deficit. It is very important to understand the concept behind working capital, and there are various reasons why it is important to manage working capital in any given organization. And some of these reasons include: one, there is a lot of time that is devoted to working capital management. Most of the managers spend most of their time in managing working capital, and therefore it is very critical to manage it in the best way possible. Apart from that, in most organizations, a lot of resources are invested in current assets. Any given organization, no matter the size of the organization, must have some current assets. More so, if you look at small firms will have more of current assets because they may not acquire the non-current assets. But there is no way they can avoid the current assets, and therefore management of working capital is very key to any given organization. Specifically, today I'm going to look at how to manage cash in any given organization. And under this concept, we are going to look at how to set an optimal cash balance. So what do we mean by this concept of optimum? Optimality simply means the best, or that amount of cash that an organization can hold to make it run effectively and efficiently at any given time. That is, an organization should avoid holding too much cash, because that is holding idle cash, which is not advisable. Again, they should not hold too little cash. They should handle that amount of cash which is enough for them to be able to manage all their day-to-day activities. And that amount which can handle the day-to-day activity is what we are referring to the optimal balance. There are different methods that are used to manage or to calculate the optimal amount of cash that an organization can hold at any given time. And these three methods include: one, the Boumol's model; we have two, the cash budget; and three, the Miller-O model. In this particular tutorial, we are going to look at the first model, which is the Boumol's model. The Boumol's model is based on three key assumptions, and the first assumption is that: one, the firm uses cash at a steady, predictable rate. So you find that in this model, we assume that any given organization understands the amount of cash that they require at any given day, and therefore they can be in a position to plan in advance. If, for example, you need 100,000 in a day, and that is how you have been spending in the previous 1 month, the previous 30 days, then it means you can keep 30,000 to 300,000, for you to be able to handle the activities of every day for that given month. So that is a steady, predictable rate of usage of cash that we are talking about here. Then the second assumption is that the cash outflow from operations also occurs at a steady rate. The operations of the organization, the day-to-day operations, they spend equal amount of cash, and therefore it is predictable. You can be able to plan in advance. That is what the Boumol's model assumes. Then the third assumption, the last assumption here, is that the cash net outflows also occur at a steady rate. The net outflows on cash that is used, also they occur at a steady rate, and therefore it is easy to predict. The Boumol's model is based on this formula here, whereby the Boumol's model is given by C equals to the root of 2 multiplied by B multiplied by T divided by I. In this formula, the C is used to represent the optimal amount of cash that is to be raised by an organization. And this optimal amount of cash can be raised in two different ways. It can be obtained by selling marketable securities or by borrowing. Marketable securities in this case refers to items like treasury bills. So you find that an organization is supposed to maintain an optimal amount of cash. For example, if an organization is supposed to maintain an amount of 100,000 every month, for example, then it means that any time during this particular month, the organization is supposed to have these as the minimal balance or the minimal amount of cash at any given time. Now, what will happen if this amount decreases or goes to, let's say, 50,000? So if the amount of 100,000 goes below 50,000, what the organization does is that they sell off any marketable securities that they are holding, and when they sell them off in the security exchange, then they are able to acquire more cash and raise the amount back to 100,000. Then what about if the amount goes up to maybe 200,000? What happens? So in this particular case, this organization is having more cash that is supposed to be holding, and therefore they are supposed to buy more marketable securities, and when they buy, they are going to release more cash, so they are going to buy marketable securities worth 100,000, and they are going to remain with 100,000, which is the optimal amount of cash that is required at that given time. So the C here simply represents the optimal amount of cash that the organization requires at any given time. Then we have B. B in this case refers to the fixed cost of making a security trade. That cost that is incurred by this organization. For example, if the organization is trading the securities in the securities exchange, and they have maybe to pay commissions to the market brokers, then that commission that is paid to these people is a cost associated with trading the securities, and that is what we are putting here under the cost, the fixed costs of making securities trade. The T represents the total annual cash requirements. How much does this organization require on annual basis? So if an organization requires 100,000 in a month, then it means that in a year they require 120,000. They require 1,200,000. They require 1,200,000. That is if they require 100,000 per month, multiplied by that by 12 months. That is the total annual cash requirement. That is what they need for the whole year. The I in the formula here represents the opportunity cost of holding cash, which equals to the interest rate on marketable securities or cost of borrowing. You can also get the total cost of the total cost, and whereby the total cost is given by this formula here. Total cost equals to a half CI plus T divided by C multiplied by B. The total cost of holding cash is equal to holding or carrying costs, the holding or carrying costs. Then you add these two, the transaction costs. That the transaction costs. So the holding or the carrying cost is represented by a half CI, and the transaction costs are represented by T divided by C plus B multiplied by B, and that is the formula below there. After looking at the formula, maybe it will be much better if we look at an illustration that will help us understand the whole concept behind maintaining optimal cash balance using the Boumol's model. Illustration. ABC Limited makes cash payments of shillings 10,000 per week. The interest rate on marketable securities is 12%. And every time the company sells marketable securities, it incurs a cost of 20 shillings. You're required: A, determine the optimal amount of marketable securities to be converted into cash every time the company makes the transfer. B, determine the total number of transfers from marketable securities to cash per year. C, determine the total cost of maintaining the cash balance per year. That is part C. Part D, determine the firm's average cash balance. Let's interpret the illustration here. So they're saying ABC Limited makes cash payments of shillings 10,000 per week. What does that mean? If they make cash payments of 10,000 per week, then it means in a year they are going to make cash payments of 12, which is in a year, So in a year, so in 1 year we have 52 weeks. There are 52 weeks in a year. So that means if we want to know how much they are going to pay in a year, we multiply that by 52. That is going to give us 520,000. That is what they make payments within in a year. Then the interest rate on marketable securities is 12%. So the 12% here represents the I, which is the interest rate. And each time the company sells marketable securities, it incurs a cost of 20 shillings. So the 20 shillings here represents the fixed costs, which we represented with B. Of course, the 10,000 per week for 52 weeks, for 52 weeks in a year will represent the total cash requirements. Solution. Let's start with part A. Part A, you're told to determine the optimal amount of marketable securities to be converted into cash every time the company makes the transfer. And we said the optimal amount of cash, which is represented by C, is calculated using this formula here, whereby C is given by the root of 2 multiplied by BT divided by I. So from our illustration, we have identified that B, being the fixed costs, they incur 20 shillings every time they sell some securities. That is the fixed cost. Then the total cash requirements in a year. So this organization, from the illustration, they require 10,000 shillings in a week. That means If they require 10,000 in a week and there are 52 weeks in a year, then they are going to require 52 multiplied by 10,000, which is 520,000 shillings per annum or in a year. The interest we are given is 12%. It's saying that the interest, that is any time they're selling these securities, the interest rate on marketable securities is at 12%. So when you replace these in the formula, we have 2 multiplied by 20, which is our B, multiplied by 520, which is our T, multiplied by, divide that by I, which is 12% or 0.12. In solving the question, this here, we get the optimal cash balance to be 13,166. So this means that at any given time, the organization have to maintain 13,166 as the optimal amount of cash at any given time. Part B of the question requires to determine the total number of transfers from marketable securities to cash per year. How many transfers need to be made from marketable securities to cash per year? So if in a year they need 520,000 shillings, and anytime they make a transfer, they have to make a transfer of a minimum, or the optimal amount of cash is 13,166. So to get the total number of transfers, you take the total annual requirement, you divide by the optimal cash requirements. That is 520,000 divided by 13,166, which is the optimal cash requirement. And that gives us 39.5. This is approximately 40 times. So it means they are going to trade in securities 40 times during the year. Part C of the question requires to determine the total cost of maintaining the cash balance per year. And we have the formula here that the total cost is given by a half CI plus T divided by C multiplied by B, whereby C is the optimal cash requirement, which we got as 13,166. Our I, which is the interest on marketable securities, that is 12% or 0.12. Then the total annual requirement was 520,000, that is 10,000 shillings per week in 52 weeks in a year. Assume that will give us 520,000. Then you, of course, you multiply by B, which was the fixed cost, 20 shillings, and lastly you divide that by 13,166, which is our optimal cash balance. So this part here will give us 790, and this other part here will also give us 790. So on addition, you get that to be 1,580. So the total cost of maintaining the optimal cash balance is shillings 1,580. Part D of the question requires to determine the firm's average cash balance. Average in the normal way, it means to the total of the items or the total value of items divided by the number of items. So the average cash balance here is given by a half C. That is, you divide the optimal cash balance by 2. That will give us 6,583. Having solved the illustration, I hope you got the concept behind maintaining an optimal cash balance using the Boumol's model. Let's meet in future tutorials where I'll be able to explain the other methods of maintaining optimal cash balance. I'll also go through other working capital management techniques, that is, management of stock and other items. My name is Peter, and I was your host in finance and accounting tutorials. Thank you very much for your time. I hope the content was of help. Kindly, if you like the content, subscribe to our YouTube channel, like and follow us so that you can get updated on any new tutorials of help to you and to others. Feel free to refer others to this tutorial. Feel free to also contact us and get more information on finance and accounting tutorials. Thank you for your time. May the Almighty God bless you.